When I'm selecting stock, I look for stock that have gapped up at least 10% over the previous day's close. But did you know that the number used in the pre-market is different than the number used at the market open? Well, today we're going to talk about what this 10% gap is, why it's important, and how I use it to select stocks. My name is Raven. Welcome to Trade with Raven. I am a new momentum trader. If you are too, come along for my journey. Subscribe below. So let's get into it. Okay, a gap happens when a stock opens significantly higher than it closed during the previous regular trading session. On the chart, it literally looks like a gap because the daily chart only covers price action between 9:30 a.m. and 4 p.m. Eastern Standard Time. So between the market closing the previous day at 4 p.m. and the market opening the next day at 9:30 a.m., there can be a gap in price. There is price action happening after market and pre-market, and for some stocks even overnight. But on the chart, it literally looks like a gap. Okay, so let's take a quick look at, let's look at a daily chart, and I will see if I can. This one is a good one. I don't know if you can see this. It's really, really small, but you can see that this stock, let me make this bigger. Okay, so here on this candle, the stock closed down here, right, at $41.71. And then it opened on the next trading day at $52.96. That right there is a gap. Okay, so the gap means that something changed overnight. It could have been a news catalyst that came in during the after hours. It could have been an earnings report that came in after hours. But traders are reacting to this change. And the gap, if it's gapping up, which is what I'm looking for, okay, I don't want it to gap down. I don't short stocks. I'm looking for stocks in the uptrend. If the stock is gapped up, that means buyers are willing to pay more today than they were yesterday, right from the get-go. Okay, so the thing is, there are actually two numbers you need to know. The difference between, there's the change from the previous day's close. Okay, so I just showed you on the chart the gap up, and that is simply the gap between the closing price the previous day and the opening price on the current day. All right, and that locks in the moment the regular session opens and never changes for the rest of the day. But what about if you're trading during the pre-market like I do? I trade from 7 a.m. to about 10 or 11. And what do I use from 7 a.m. to 9:30 a.m. when the regular session opens? Well, that would be the change from the previous day's close. So that would be the difference between the previous day's close and the current price at that moment. And that updates in real time all day long. Okay, so in the pre-market, that's really the only number that you have. There's no official gap yet because the regular session hasn't opened, and that's your pre-market scanning number. So if the stock is showing a 10% change or more from the previous day's close at, say, 7:30 a.m., it can go on the watch list, or my watch list. You might not put it on your watch list, but I'm putting it on my watch list. Okay, it's one of several criteria for stock selection that I use in conjunction. I don't use any indicator in isolation. Okay, after 9:30 a.m., now I have two numbers. I have the price difference between the current price and the previous day's close, but I also will have the gap percentage from the previous day's close to that open. So now I have two numbers to work with, which is better, right? Okay. So it's great at 9:30 a.m. to have both numbers. It just adds more information that's pointing in the same direction. If a stock has gapped up between the close from the previous day to the open at 15%, and now it's showing like say at 9:40, it's showing a 25% change from the previous close. You can see that momentum is building. However, if the change from the previous day's close compared to the current price is dropping, momentum is slowing. So when I use Warrior Traders scanners, they actually have there's a column for each of those numbers, which is really helpful. Now on Thinkorswim, I haven't looked at this extensively, but I will show you one thing that you can do on your watch list is you can add the previous day's close to your watch list. So you can eyeball, for example, here, it's saying this must have been the closing price, but let's just pretend it's the price at that moment. 207, if 207 is the current price and the previous day's close is $1.50, that's about 33% increase in price. So I would say that's above 10%. So you can sort of eyeball it if you add the close. And the way you add a column to your watch list in Thinkorswim is you click on the little gear, click customize, and over here on the columns, there are so many options. I obviously don't use all of these indicators. And then I plug in close and it brings up yesterday's close, okay? And which is what I had added to the chart, okay? But the title at the top just says close. So that is one way that you can put it on your Thinkorswim watch list and sort of eyeball it and keep an eye on it that way. Okay, if you know of a better way, I know there's also a way to put it on your charts. If you know a better way to look at it in Thinkorswim, post it in the comments below, because Thinkorswim, I use them because they're a commission-free broker, and I'm sure a lot of other new traders use commission-free brokers like Thinkorswim or Webull. So let's work together, right? Okay. Why 10%? Why not 5% or 20%? Well, 5% is just too small. A 5% move on a small stock can happen on very little news or just normal volatility. It doesn't signal enough unusual activity to attract the momentum and volume that you need to determine if this is a good stock to trade. 20% is not wrong. It's just restrictive. If you're going to have a much smaller pool of stocks to select from, okay? And if they're gapping up that much, they might be really extended. And the risk of reversal is higher for sure. So you might miss setups at that percentage. 10% is a sweet spot. It's significant enough to signal that something real happened overnight, but it's not so extended that the best move is over before you even get in. Okay, 10% filters out the noise, and you're only looking at stocks where something real happened and the market is reacting to that. Okay, what are some things that could cause a gap? Earnings reports, if they come out after market. And again, one of my viewers asked about continuation stocks. I have had mixed results with continuation stocks. That is different than what we're talking about here, okay? But you can get a gap from news from the aftermarket, after hours the night before. So FDA approvals, partnerships, short squeezes developing overnight, sector news. If something happens in the market as a whole, that can affect a stock overnight. The gap up is in a reaction to the catalyst that might have come out after hours. But if the stock is gapping up and there's no catalyst, that's a little bit concerning. Okay, so this is why you want to work with the news catalyst and the gap up together. And that's going to help. The more criteria you have pointing in the same direction, the better. And honestly, because it's been a slower market lately, and I am a new trader, I am not playing loose with my stock selection criteria. I am being extremely conservative about it. And I have found that every time I trade a stock that doesn't meet all of my stock selection criteria, I have a higher chance of that stock going red. Okay, so I did show you how to kind of eyeball it in Thinkorswim. Okay, so let's go over a little bit about how it works with your other stock selection criteria. So I use Warrior Trading's five criteria of stock selection, and that's one of them. So looking at the gap in price tells you that the stock has moved. The catalyst tells you why. So the news catalyst is the why. The gapping up is the price change. Okay, both together confirm that something real happened and the market is reacting. Okay, gapping up with volume. Okay, so if you have the price gapping up 10% above the previous day's close with 5 times relative volume, that means the traders are reacting significantly. It's a significant reaction. They might react, right? The price is going up, but you want to see that the volume of buying and selling is also increasing. All right, the gap up with the float, which is another criteria of stock selection. I look for stocks that have a float under 20 million, ideally under 10 million. If the price is gapping up more than 10% above yesterday's close on a low float stock, that shows an explosive price action compared to the number of shares. All right. So when you look at all of the stock selection criteria together, that gives you a more complete picture. And that's what we're looking for. We're looking for a complete picture. Okay, common beginner mistakes. Trading any gap up regardless of size. It's like, ooh, it gapped up 1%. That's not enough. Okay, you want to see something significant like 10%. Only looking at gap and missing the other criteria for stock selection, big no-no. Okay, we don't want to look at any one particular criteria for stock selection in isolation. You have to look at them in conjunction with one another, right? Right? Okay. I'm watching you. And you want to take a look at, this is why you need a news catalyst that explains why is the price going up. Okay. Okay, so we definitely don't want to confuse an increase in the absolute dollar amount with the percentage, because a $1 stock with a 10% gap is going to be at 110, right? But a $50 stock is going to have a much bigger move in price for the same percent gap. So you want to make sure that you're looking at the percentage, not the absolute dollar amount. However, like I said on Thinkorswim, that's one way to eyeball it, right? You can look at the price. If you can calculate that in your head quickly enough while everything else is happening, good luck. Then you're good at math. Okay, let's do a quick recap as far as what the gap up is. A gap up is when a stock opens significantly higher than the previous day's closing price, and that is the price at 4 p.m. Okay, we have two numbers. One is the gap up percentage change, where you are simply looking at the gap between the previous day's close at 4 p.m. and the opening price at 9:30 a.m. market open. And I'm giving you times for Eastern Standard Time, obviously. That is my time zone. The second number is the gap between the previous day's closing price and the current price. And that's what I use in the pre-market. Okay. And the gap up works with your other criteria for stock selection. Okay. You want your price to be between $1 and $10. I mean, I had 1 and 20, but I usually stick to $1 and $10. Okay, you want your relative volume to be 5 times the 50-day average. You want your float to be under 20 million, and you want to have a news catalyst, a good news catalyst, okay? So if this, that's pretty much Gap. If this helped you, subscribe to my channel. I'm on my trading journey. Come along for the ride. I'm also posting Mondays, Wednesdays, and Fridays over on Substack. I am selecting a weekly goal that I'm going to work on and track every week. So hop on over there and subscribe to me there. And I will see you next time. Trade smart.